This 70-year-old book still guides billionaires today. Warren Buffett calls it the single greatest book on investing ever written. It's Benjamin Graham's The Intelligent Investor, a timeless guide that's less about chasing hot stocks and more about mastering your emotions, building discipline, and protecting your money. Let's dive in. Welcome back to the channel. If you're new here, I take the world's greatest finance and investing books and break them down into lessons you can use right away. In this video, we're unpacking the key ideas from The Intelligent Investor, a book written in 1949, but still essential for investors today. Lesson 1. Meet Mr. Market. Imagine you own a share in a business. Every day, your business partner, Mr. Market, shows up at your door. Some days is euphoric, offering to buy your share at an insanely high price. Other days is depressed, offering to sell his share to you at a ridiculously low price. Most people ride the emotional roller coaster with him, buying when he's excited and selling when he's fearful. But Graham says the intelligent investor ignores Mr. Market's mood swings. Instead, they take advantage of them, buying when prices are low and ignoring the temptation to overpay when prices are high. This is why Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Lesson 2. Defensive versus enterprising investors. Graham divides investors into two categories. The defensive investor wants safety and simplicity. They don't want to spend hours analyzing stocks. A defensive investor might keep 50% in bonds, 50% in stocks, or simply invest steadily in index funds. The focus here is preservation of capital, not chasing massive returns. The enterprising investor wants to put in the work. They dig into balance sheets, study industries, and look for undervalued companies. Enterprising investors aren't gamblers. They're detectives searching for bargains in the market. The choice isn't about intelligence. It's about temperament. Ask yourself, do you want hands-off safety, or are you willing to do the work of a stock detective? Lesson 3. The margin of safety principle. This is a cornerstone of Graham's philosophy. The margin of safety means buying investments for less than their intrinsic value. Think about how engineers build bridges. If a bridge is meant to carry 10,000 pounds, they design it to hold 15,000 or 20,000. That buffer is the margin of safety. For investors, that means if you think a company is worth $100 a share, you don't buy it at $100. You wait until it's $70 or $60. That way, even if your analysis is wrong or the market shifts, you've built in protection. This principle is a difference between speculation and intelligent investing. Lesson 4. Speculation versus investment. Graham warns us, there's nothing wrong with speculating as long as you know you're speculating. The danger comes when you confuse speculation with investment. Investing is analyzing a business, buying it with a margin of safety, and holding for the long term. Speculating is buying because you think the price will go up based on trends, hype, or emotion. In today's world, meme stocks, crypto pumps, and get-rich-quick plays are speculation. Graham says it's fine to speculate, but limit it and don't fool yourself into thinking it's investing. Lesson 5. The role of discipline. Graham insists the market is unpredictable. No one can consistently forecast crashes or booms. That means the intelligent investor doesn't waste energy trying to time the market. Instead, they build discipline. That means regularly investing, even when the market looks scary, sticking to your plan instead of chasing fads, rebalancing between stocks and bonds to control risk. Warren Buffett puts it perfectly. The market is there to serve you, not instruct you. Use it when it offers you a bargain. Ignore it when it's irrational. Lesson 6. Inflation and protection. Graham also warned about inflation eating away at wealth. He suggested owning a mix of stocks for growth and bonds for stability. Today, that might mean diversifying across stocks, bonds, real estate, and even index funds that track inflation-resistant sectors. The key idea, don't assume the dollar you save today will have the same value tomorrow. Protect your wealth from erosion. Lesson 7. Don't follow the crowd. One of Graham's most powerful lessons is psychological. Most investors fail because they follow the herd. They buy when prices are high, because everyone else is buying. They sell when prices are low, because everyone else is panicking. The intelligent investor flips this pattern. They stay calm when others are greedy, and courageous when others are fearful. That's what separates winners from losers. Key takeaway. The intelligent investor isn't about beating the market in the short term. It's about avoiding the big mistakes that wipe people out. If you can stay rational, buy with a margin of safety, and stick to your plan, you'll outperform most people, not because you're smarter, but because you're more disciplined. In conclusion, so, are you investing intelligently, or are you letting Mr. Market's emotions push you around? Let me know in the comments. What's the hardest part for you? Staying patient, resisting hype, or finding good deals? If you enjoyed this breakdown, hit like, subscribe, and share this video with someone who wants to build smarter investing habits. And remember, investing isn't about predicting the future, it's about preparing for it.